Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out why some companies act like they bought their business degree at a cereal box raffle. Today we are digging into 707 Cayman Holdings Limited's annual report Form 20. Now on the surface, this looks like any other big corporate document, but trust me, there are some juicy details in here about how this company is trying to make it big in the apparel world. Before we dive in, a quick reminder, if you like decoding these financial documents to get the real story, hit that subscribe button and ring the bell. We are building a great community on our Discord server too. A link is in the description below, so join us there to keep the conversation going. Let's start by understanding the big picture. This company is all about apparel supply chain management. Think of them as the wizards behind the curtain, making sure your favorite clothes get from the factory to the store. They handle everything from market trend analysis and design to production and logistics. They are based in Hong Kong and their reporting currency is the US dollar. Now let's jump straight into the financials because that is where the real story is. For the fiscal year ending the 30th of September 2025, the company reported a total revenue of about 106.9 million Hong Kong dollars, which translates to roughly 13.7 million US dollars. This is a significant increase of over 21% from the previous year. That sounds great, right? More sales means more success. However, hold on to your hats because while revenue shot up, the cost of making those sales also increased dramatically. It jumped by about 37% to 85.6 million Hong Kong dollars or 11 million US dollars. This means the cost of goods sold grew faster than their revenue, and that is why their gross profit actually took a hit. It decreased by almost 17% to 21.3 million Hong Kong dollars. This is a pretty important signal to watch. Their gross margin dropped to about 19.9% from 29.1% the year before. This tells us that what they are selling costs them more to produce or obtain than it did previously, and they are not able to pass all of that cost increase onto their customers. And why did profits shrink so much for the year ending the 30th of September 2025? We see a massive new expense here, share-based compensation, coming in at 43.9 million Hong Kong dollars. This is a non-cash expense, meaning they did not actually spend this money, but it hit their reported profit. This often happens when a company grants stock awards to employees or service providers, and has to account for the value of that stock. In this case, it looks like they gave out a lot of stock to consultants for marketing and business development. This significantly impacted their bottom line, turning a profit into a big loss. This big chunk of share-based compensation is a main reason why the company went from an operating income of 9.4 million Hong Kong dollars in 2024 to an operating loss of 40 million Hong Kong dollars in 2025. And that brings us to the final number, the net income or loss. For the year ending the 30th of September 2025, the company reported a net loss of 40.9 million Hong Kong dollars, or about 5.2 million US dollars. This is a huge turnaround from a net income of 7.4 million Hong Kong dollars the year before. The share-based compensation expense is the primary driver of this dramatic shift. Now, even with this big loss and shrinking gross profit margins, the company is trying to grow. They are expanding into new markets like North America, which is partly why their costs went up. There was an increase in freight costs, and they adopted more competitive pricing strategies to attract new customers. This is a common strategy, aggressive pricing to gain market share, but it does eat into profits in the short term. Let's look at their accounts receivable. This is the money owed to them by customers. As of the 30th of September 2025, accounts receivable increased significantly to 25 million Hong Kong dollars, or about 3.2 million US dollars, up from 7.4 million Hong Kong dollars the year before. This increase is directly tied to their sales volume expansion. The turnover days also increased, meaning it is taking longer for their customers to pay them, from 32 days in 2024 to 56 days in 2025. This means they are essentially lending more money to their customers for longer periods, which can tie up cash. On the flip side, their cash position looks strong, ending 2025 with about 40 million Hong Kong dollars or 5.1 million US dollars. This is a big jump from the previous year, boosted by their initial public offering, or IPO. They raised about 5.2 million US dollars in June 2025. This IPO cash injection is crucial given their recent operating loss. Looking at who owns the company, Mr. Chung Lui, their CEO, and his entity, Cayman Holdings Limited, hold a controlling stake of almost 60%. This makes them a controlled company under NASDAQ rules, which means they are exempt from certain corporate governance rules. This is important because it means shareholders might have less protection in some areas. The company also engages in transactions with related parties. Mr. Chung and an entity controlled by Mr. Says 7 Retail Limited and Red and Blue LLC are involved in various transactions. For example, Red and Blue LLC had product sales with them totaling over $1 million Hong Kong dollars in 2025. While these might be on normal commercial terms, it is always something to keep an eye on for potential conflicts of interest. Looking at the risk factors, they highlight currency exchange rates and economic conditions as potential risks. Their reliance on a few major customers is also noted. For 2025-3, customers alone accounted for about 72% of their revenue. If even one of these big customers leaves, it could significantly impact their business. Similarly, their top vendors make up a large portion of their purchases. Overall, 707 Cayman Holdings Limited is in an interesting spot. They are growing revenue rapidly, showing great market demand for their services. However, their profitability took a massive hit in 2025, mainly due to a significant non-cash compensation expense. This is a common challenge for growing companies, especially those going public. They are investing in expansion in new markets, which is good for long-term growth, but it leads to higher costs and lower margins in the short term. The increased accounts receivable indicates sales growth, but also a tighter cash flow situation. The IPO provided much needed cash to fuel these growth initiatives and cover operational costs. The company's direction seems to be focused on expansion and leveraging their existing strengths in supply chain management, possibly by developing their own brands in the future. The key will be managing those rising costs and improving profitability as they grow. For investors, it is crucial to watch how they navigate competition and if they can maintain their customer relationships while increasing their margins. That is our deep dive into 707 Cayman Holdings Limited's latest filing. What do you think about their financial performance and future strategies? Let me know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more decoded corporate stories. And don't forget to join our awesome community on Discord linked in the description. Thanks for watching and we'll see you next time on Corporate Decoder.